Chart Pattern Example Case Study 75, PEP, a long-term trend line and upper range with clear past price action provides excellent reference for resistance during a long-term recovery. A small-scale Head & Shoulders provides finer details within the long-term ranges. The drop is paused almost as soon as it starts from the break under the 70-20 neckline. This is due to the large bullish candle's shorter-term influence from the end of April that is similar to the phenomenon when the neckline area is expanded due to a recent gap up. The pause at the brief 67 to 68 support area leads to a normal bullish retracement that is repelled by the firm 70-20 neckline. This helps define a shallow long-term downtrend line and a new shorter-term trend line. Both downtrend lines prove to be helpful guides, as normal neutral to bullish price action develops after price crosses over them. Despite stronger resistance potential from the approximate area where the shallower downtrend line and the long-term 65-70 level intersect, a steady incline is maintained. This reveals the 67 to 66-60 range to be the approximate area of a potential ascending triangle. After a gap down leads to a failed ascending triangle, selling volume is quickly exhausted. When price declines to the lower 60s, where a double bottom quickly begins a reversal to eventually fill the gap down. Here is almost the exact same situation, except there is a successful ascending triangle. Towards the end, there is some more compact and volatile price action, but the small-scale upswings present Morningstar price action to maintain the stable incline while bullish volume increases. Here is a good example where trend lines from multiple patterns help clarify an upswing into early June that has a short-term delay. The uptrend line from the successful ascending triangle and double bottom overlap with the already solid 67 level to add extra strong support potential to the ascending triangle's upper boundary. This promptly halts a natural bearish retracement that just happens to originate from a double top at 68.90 in May. Interestingly, the strict double top was a weak bearish range, since it mainly comprised of strong bullish candles and volume. Further utility of the two uptrend lines used as one wider upward channel is demonstrated as they each become the site of separate and precise upswings in late June for the upper trend line and late July for the lower trend line. Trends won't always have swing points on the exact same angle, but often do present the same general trajectory with varied swing points like here. A variation of the Head & Shoulders breaks the strong support potential offered by the two trend lines. This is a variation of the basic Head & Shoulders outline, with a steeper right shoulder and a double top range for the head and left shoulder. As would be expected when the larger uptrend resumes into 2013, the 79 range offers key long-term support for a successful bullish continuation.